Welcome back to Your Average Investor. Today we're going to be talking about dividends. What is a dividend? Why would a company pay it? What are things I should look for in a dividend company? And how do I get paid? Do they send me cash? Do they send me a check? Well, don't worry. If you're a noob here, we're going to talk you through it all. If you know a little bit, we're going to hopefully help you learn a little bit more. And if nothing else, help you decide what might be some good dividend companies to invest in for the long term. As always, this is not financial advice. Do your own research. Anything we talk about here is just for education purposes. And hit that subscribe button to help us monetize this channel so we can get some juicy dividends from YouTube. Now, a dividend is simply money that a company pays to shareholders based on excess earnings. And it's a way to give value back to shareholders. Some companies don't pay dividends. Usually that would be a company that's in a large growth phase or is using cash to continue to grow their market share. So like for example, Amazon is one that is famous for continuing to not pay dividends and instead just reinvest the company profits into company growth. Now, if you'd been an Amazon investor for say the last, I don't know, 10 years or so since 2014, you're not going to be complaining because you bought in at $14 a share adjusted for stock splits, and Amazon's trading now at nearly $200 a share, so you'd be happy with those gains regardless. But dividends are nice because it's actual cash that gets put in your pocket, and I would imagine at some point Amazon probably starts paying a dividend. So let's look at a couple of companies that do pay dividends so you can see what that looks like. This is Realty Income, and on these stock charts here, what these little green bubbles represent are every time the company has paid a dividend. And I'm going to zoom in even closer so you can see those. And you can see the number there. If it's not too small, it says dividend $0.256. What that means is that Realty Income at this point paid $0.256 per share that you owned in a dividend. So if you owned, let's just say, 1,000 shares of Realty Income, and they paid you 25.6 cents per share, you would have received a payment of $256 on this day just for holding those 1,000 shares of Realty Income. And Realty Income happens to pay dividends every single month. You can see here every month they're paying a new dividend, and you'll notice these last two payments, the dividend increased from the time before, where right here it was 0.256, it is now 0.257, and recently they announced that they would be increasing the dividend payment by about another 2%. And if I continue on back here, you can see about a year ago it was at 24 cents, 0.7 per share, and so that dividend has been steadily increasing. Now, some companies, like for example Walmart, they don't pay a monthly dividend, but instead they pay a quarterly dividend. And typically, a company that's going to pay a monthly dividend will be something like a REIT, which stands for Real Estate Investment Trust, where they're collecting monthly payments from their paying renters. They're going to then turn around and pay those monthly payments out. In fact, they're required to, by law, pay, I believe it's 90% out as dividends. Where Walmart, they're going to pay a dividend once per quarter when they report, or around when they report quarterly earnings. And sometimes they will issue what's called a special dividend. But in this case, you can see Walmart is paying quarterly dividends with occasional special dividends. Costco is another one that has become famous recently for its special dividends, like this one that it announced at the end of last year for $15 per share. So you can see typically they've been paying $1 per share per quarter, and then they just decided, hey, we made a ton more profit than we expected this year. We're going to issue a massive dividend to all of our shareholders. And of course, shareholders love that because if you've been, let's say you bought a whole bunch of Costco back here at the COVID, this is the pre-COVID dip actually. So say you got in at like $170 per share, right? Let's say you bought $10,000 worth of Costco for $170 per share. You'd have about 58 shares of Costco, and then if you got that special dividend of $15 per share, that would have been almost $1,000. Very nice Christmas bonus. Now, if a company is paying dividends, they don't always have to continue paying those dividends. For example, Disney, which for a long time was considered a dividend aristocrat or dividend king, which basically means a company's been paying dividends consistently for a certain number of time, and those dividends are always going up. Well, they suspended their dividend back in 2020 around the time that COVID hit, and they have not reinstated it. They paid one small dividend recently, and people were getting excited thinking maybe it had been reinstated, but it was just a one-time event. And so companies can choose whether or not they want to continue to pay dividends or stop paying dividends. And that is one of the risks of dividend investing, depending on the company you're in, right? If you're in, again, a real estate investment trust like Realty Income, they are required by law to pay out their profits as dividends, whereas a company like Disney or Tesla, as an example, right? Tesla's never paid a dividend. Maybe they will one day. Ford's another great example. Ford paid dividends for a long time, but they've had a little bit of a spotty history where occasionally they've stopped paying dividends and recently they've restarted them. So again, Ford stopped paying dividends during COVID and then restarted their dividends again recently. Now, if you're looking to get into dividend investing, usually it's because you want some sort of monthly cash flow that's totally passive that you can just check out and not have to worry about at all. And that's great if you believe the company is going to continue to perform well for the next, say, 10, 20, 40, 100 years, however long you plan on being alive and collecting those dividends. However, as we've seen here, sometimes companies stop paying the dividends. Sometimes companies go out of business and fail. So what can you do to insulate against that? Well, in that case, if you'd like, you could invest in something like the S&P 500. So SPY, which is an ETF that tracks the S&P 500, pays a dividend every quarter. Now, because of how they pay and because they're an ETF, the dividends are not going to show up down here, the quarterly dividends, but I'll show you where you can see that. A great site for this is just to use NASDAQ.com. And on NASDAQ.com, you can type in any stock ticker you want and then look for their dividend history. So here's Walmart's dividend history. You can see there's a few interesting dates here. We're going to go over each of them and what they mean. First is the ex-dividend date. This is referred to as the day that the dividend's paid out. Usually the reason that's important is because the stock will drop on that day by the amount of the dividend paid. It's just kind of basic assumption. If the company used to have 83 cents per share, or well, in this case, 20 cents per share that they were holding on to, then it's worth 20 cents per share more. But now that they've paid that out to investors, just by raw math, it's worth 20 cents per share less because they no longer have that cash. Now, in addition to the ex-dividend date, there's the declaration date. This is the date that the company declares that they're paying the dividend and what the dividend will be. There's the record date. This is the date that you have to own the stock by in order to receive that dividend. So in this case, Walmart declared on February 20th that they would be paying a dividend. They said the record date, meaning if you own shares on or before 8/16, you will receive this dividend payment, and then it gets paid out a couple of weeks later on 9/03. And so you can't just buy the stock right before the dividend, collect the dividend, and then sell it the next day, because you do have to hold it by the record date in order to receive the dividend payment. And that just makes it so there's a little bit of risk where if the stock moves up or down, then of course you're going to have to accept that underlying risk and not just be able to collect the dividend for free. That being said, typically if you're of the mindset of investing in dividend companies, you're not worried about those small fluctuations in stock prices. What you want is something like Walmart, where if we go back in time on Walmart, you can see they paid their very first dividend here in 1995. Now, I want to highlight how powerful this can be if you're a dividend investor. We're going to look at Walmart, and we're going to go back to 1995 to see what the price of Walmart was back then. So you can see no dividend along here, but in 1995 they did start paying a dividend. So let's say you bought just at the very beginning of 1995, or actually let's see when they declared this. They declared this in June of 1995. So let's say you saw that Walmart was going to start paying a dividend and you decided to become an investor in June of 95. That would have been right here, and you would have bought in, adjusted for stock splits, at about $4 per share. $4 per share. Wow, what an incredible price when you see how Walmart's doing today, up at $65 per share. Now, since then, they've had several stock splits, but you get paid 5 cents per share, and your dividend is a healthy. You can calculate the dividend yield just by going like this. So if they're paying 5 cents per share and they're paying quarterly, you're going to times that by 4. So that's going to be the assumption of what the payment will be for the year, 20 cents. And then you're going to divide that by the stock price. Say you got it for 4.5. That's a dividend of about 4.4%. So you're getting a nice dividend of about 4.5%, nice and easy. But look what happens after a few quarters. They bump that dividend up by a quarter of a penny, and then a year later they bump that dividend again, and then they bump it again, then they cut the dividend, right? So this would be an example of a dividend cut. Prior they were paying about 7 cents, almost 8 cents per share per quarter. They got up to 10 cents, and then something happened where they decided, hey, we need to cut back. Profits aren't as good as we thought, and they dropped back down to 5 cents per share. Then the march continues: 6 cents, 7 cents, 7.5, 9 cents, 13 cents per share. Look at that jump, 13, 15. And as we zoom on forward through time, you can see this dividend gets higher and higher and higher. And let me go back to the chart here so you can see, right? Recently, I think this data actually is not updated. Recently, Walmart issued a 3-for-1 stock split. I believe these numbers still need to be updated actually to reflect that, which is why it looks like Walmart cut its dividend in half. I don't believe that's the case. I'll have to double check after this video, but I believe this was paid on the stock split basis. So what you do is go 0.57 divided by 3. That was actually a 19 cents per share dividend, and now they've increased their dividend again to 20.75 cents per share. And that's the power here, right? So now every single year you are getting 20 cents 20 cents times 4, so you're getting 80 cents per share of Walmart that you own. In addition to that, if you stuck with Walmart, let's look at a Walmart stock split history here. I want to see their stock split history. And look at this. So remember, 95 was when that first dividend was introduced. So you would have missed out on all of these stock splits, but let's just say you bought in. What you have here is a 2-for-1 stock split, and then a 3-for-1 stock split right after. So let's say you had bought 100 shares of Walmart back then at $4.50 per share just today. But then that stock split would have happened, so now you're going to times that by 2. You'd have 200 shares. And then another stock split happened. You're going to have an extra 3-for-1 stock split. So now you have 600 shares that you're being paid 80 cents a share per year for. So you're making $480 a year off of that initial investment in Walmart. Seems like a phenomenal company, phenomenal way to earn income, again, over a nice, in this case, we're looking at a 35-year period. So the question is what's the next Walmart, right? What's the next company that is starting to pay a dividend, where that dividend is going to increase and the stock price is going to increase over the next 20, 30 years? Because if you didn't want to do something like Walmart, which, again, pays a yield of 1.28% right now, you could also look at stocks like Home Depot, slightly higher yield, a 2.74% yield. And you can see here again in that same thing, they started their dividend in 1995. Dividend marches on up through the years, continues to get higher and higher and higher, and now they're up to $2.25 per share per quarter. Excellent dividend, especially if Home Depot continues to perform over time and increase their dividends. You hold that for a 10-year period. Like, let's just look. So pretend you had bought 10 years prior. Let's see what the dividend was 10 years ago. It's 47 cents per share. So in 10 years, they have over quadrupled their dividend. So let's say you hold for 10 years again, right? This is where I want to make this point. Let's say you hold for 10 years again, and Home Depot has about the same track record that they did of the last 10 years. So here we have, we got to go back to like 2014. So here we have 2014. Let's say you bought right here at about $80 per share. You'd be up by about 400%, right? 80 to 160 to 320. So you'd be up about 400% right now on the stock, and you'd be making a dividend. You remember, you bought in at $80, and your dividend is now $2.25 per share per quarter. So let's go 2.25 times 4, $9 per quarter. But remember, you bought in at $80 per share, so your effective dividend yield is 11%, because that's where you bought in at. And of course, if you liked Home Depot, you probably would have been buying in over time or doing what's called drip investing, which is where every single time you're paid a dividend, you simply reinvest those dividends back into the company. So, say you had 100 shares of Home Depot and they paid you a dividend of 2.25, you'd make $225, and you'd buy, I guess in this case, a partial share. Maybe you'd add $100 yourself. and buy a share of Home Depot with that, so it continues to increase your position over time. But again, you'd have that 10% yield. So if you bought in today and that same forward growth happened, your yield would be about 10% based on your purchase price. Now you have some stocks like Realty Income. Look at Realty Income. They market themselves. Oops, I accidentally clicked on an ad. Trying to close it. They market themselves as the monthly dividend company. They love to pay monthly dividends, and they have a dividend yield much higher. You can see at almost 6% right now, which is quite incredible. And if you look at their dividend history, they haven't been paying dividends quite as long, even though the chart looks really long because they pay monthly. Actually, they have 95. Would you look at that? 1995. They've been paying just as long, and since then, their dividends have continuously increased. They did have a period of decrease here, but overall, the trend is upward from 10 cents a share all the way now where they're doing 26 cents per share per month. Remember, this is a monthly dividend, not a quarterly dividend. Now, the great thing about monthly dividends is if you are drip investing, this gives you an opportunity to compound significantly faster because you don't have to wait every 3 months to receive your payment. You get that payment every single month, and you can just reinvest it right back into the company. So let's just say, again, you owned 1,000 shares of Realty Income, and you are getting paid a dividend this month of $2,625 per share. So you're going to be getting $262, which means you can now turn around, and let's look at Realty Income. I think they're trading about $52 a share, 51.7 right now. So $51 per share. That means you could go and buy 5 more shares of Realty Income, which increases, that 5 shares now increases your dividend payments by an extra $1.25 per month. So every single month you're increasing your dividends by $1 per month, which is just a phenomenal way to look at it. The risk here, of course, along with Home Depot or Walmart or anything like that, is you get a situation like Disney, where they suddenly stop paying their dividend, and you don't know if they're going to reinstate it yet. So you can see they paid consistent. They paid one little dividend payment here in 2023, one little dividend payment here in 2024. And it's not clear if they've totally reinstated their dividend yet. Maybe it is actually. If someone is a big Disney investor and they know for sure, please correct me in the comments below, but I'm pretty certain they haven't officially reinstated their quarterly dividend yet. And that's a risk, right? Is, oh man, my monthly income I was counting on isn't there anymore. So now I've got to find a different stock. Well, that's where something like the S&P 500 comes in handy, because the S&P 500, let's just look at SPY Holdings. I'll show you what this is. So the S&P 500, it holds a basket of companies, and we're going to look at that basket of companies right here. So here's their top holdings. They hold a lot more than this, but this is the top holdings. Microsoft, Nvidia, Apple, Amazon, Meta, that's Facebook, Alphabet, that's Google, Berkshire, Eli Lilly and Co., Broadcom. They intend to, and what they do is they constantly rebalance the portfolio and add companies and drop companies based on how they are performing. And you can see how their breakdown is. They have 30% in IT, 12% in financials. This is bank stocks like JP Morgan, industrials, communication services, healthcare, discretionary, consumer staples, energy, utilities, real estate, and materials. So a very healthy, broad mix of stocks to invest in. And what's beautiful about it is they pay a 1.2% dividend yield. Now, if you remember, that's barely any lower than Walmart. Walmart's paying 1.28%. The S&P 500 right now is paying a 1.2% dividend yield, which is quite phenomenal. Now, their dividend's a little bit trickier because they have so many companies within their basket that pay dividends, and they just turn around and feed those dividends to you, that that you're going to see some odd fluctuations like this, where it's like 1.59 with a whole bunch, 1.9, 1.63, 1.5. Lots of oddness in here, but overall the trend is that it goes up. You can see here 1995 dividend of 31 cents, and if you had held since then, we're now sitting at a dividend of we'll call it 1.6 per share, just an average 1.6 per share of these last 4 quarters. So that's increased by about 550%. Really good increase in dividend income, and if you continue it to hold for the next 30 years, then it does that same thing again, ideally, right? As long as America still exists. So if you want to be the absolute safest dividend investor possible and just have a very safe stock that literally you never have to think about it again, that would be the S&P 500. Just buy SPY. Or you could buy QQQ or any other type of ETF like this that pays a dividend and is a broad basket of stocks. Like VOO is another one. VOO, dividend history. This is one a lot of people really like is VOO, right? About the same 1.27 dividend yield, very, very similar to SPY in terms of what they hold. And I think the reason some people like VOO better is simply that I think it has a slightly lower servicing fee for the ETF, but I digress. So this is a very safe way to do dividends because you know you're going to be getting those quarterly dividends. It's on a broad basket of stocks. You don't have to worry about any single stock like Disney stopping to pay their dividend or going out of business or just having a rough patch like airline stocks right now, right? It's like say you were a big Boeing investor, and Boeing, look at this is a great example. For a long time paid an excellent dividend. COVID happens, they just tank, and they have just struggled to recover since then, and they haven't reinstated their dividend. And so who knows, maybe Boeing gets replaced by someone else over the next 20 years as if they continue to struggle, and maybe SpaceX becomes the new Boeing, the manufacturer of planes and space shuttles and everything in between. But that risk is taken away when you put your money in something like SPY or VOO, Vanguard S&P 500 ETF. See, they're both the same thing. It's just this is the SPDR ETF and this is the Vanguard ETF. So roughly the same. But regardless of that, this is the importance of dividend investing is you buy these stocks, you hold them over 10, 20 years, the dividends go up, the stocks go up, and now you have monthly passive income, literally 100% passive income that you can just continue to reinvest until you get to the point that you need it. Now, the last thing to talk about here are taxes. How taxes work with the stock market is you have two different types of tax. You have long-term capital gains tax, and then you have short-term capital gains tax. Short-term capital gains is anything that you held for less than a year. So if I bought Boeing today, because I'm like, hey, you know what? I like this dip on Boeing. I think it's a good dip to buy in on, and I'm going to get a bunch of Boeing here at $170 per share or whatever it is, right? And I'm going to try to sell it at like 187, make a nice little flip in a month. Well, that's going to be taxed at what's called short-term capital gains, which is just it's ordinary income tax. So whatever your tax bracket is, that's the tax you'll be paying. Now, if you hold for a year or longer, it's taxed under long-term capital gains, which depending on your tax bracket will be either 10, 15, or 20%, I believe is the max tier on long-term capital gains tax. And that's only with realized capital gains. That's this big discussion around should we tax unrealized capital gains, because what if somebody's been holding stocks for so long and they're up to $1 billion and they've never had to pay taxes on it? Well, the fact that they've never paid taxes on it is because they've held it, and because they're still holding the stock, they haven't actually profited from it because, well, they've never sold it to cash out and use that cash. And if the stock was paying dividends, they would pay tax on those dividends. Dividends are taxed at long-term capital gains tax rate of 10, 15, or 20%, depending on tax bracket. That is, unless you are investing, and I'm not a tax expert, just like this is not stock advice, this is not tax advice. But if you're investing in a Roth IRA, Roth IRAs are tax-free investment vehicles because the money that you use to fund them is post-tax money. So if you earn, say, $100,000 as your yearly salary, and you're taxed at like a 27% tax rate, so it's going to take out $27,000. It'd be closer probably to 32 with state taxes. So we'll say you're left with $68,000. And let's say you decide, and you can only put in, I think the max right now is $8,500 a year, but you can only put in $8,500 a year into a Roth IRA. So let's say you throw in that $8,000. This $8,000 has already been taxed by your income tax, and because of that, on your Roth IRA, you are not taxed on any of the gains. So that means dividends are tax-free, capital appreciation is tax-free. Anything that you buy in a Roth IRA, as it appreciates when you sell it, it's tax-free. The caveat is you cannot withdraw the funds until, I believe, it's 62 and a half years old, at which point you would be using them for retirement. So it's an excellent retirement vehicle, and it provides phenomenal income. Actually, I think the rule on that is you can't, you can withdraw the principal, but you can't withdraw the gains. So let's say I put in, I had put in over a few years $25,000, and it had appreciated to, $50,000. So it had doubled in price, right? Oops, not plus 2, times 2. Then at that point, I could withdraw my initial $25,000 that I had put in, but I could not withdraw the gains that I had received on top of it. So you can withdraw the, I believe that's the case. And again, go do your own research on that. Consult someone else. Consult Google if you want. I'm not a professional here, but I believe that's how it works. But because of that, your funds are tied up as well as the dividends and the other monthly payments. So you couldn't use that as a way to consistently retire early if you were looking to do a financial independence, retire early type track, fire track, because those funds will be tied up till you're 60 plus years old. There are some exceptions to that rule, such as extenuating circumstances, loss of income, if you're using the cash to buy a house, things like that. But in general, the rule is that you are not able to touch the gains in that account until you hit a certain age. But it's still a fantastic thing to be putting money into, because again, you can only put in $8,000 a year into it. And hopefully you can invest a lot more than $8,000 a year. Wherever you're at now is fine. Just make sure every year you're increasing how much you're putting away. So let's say you have an IRA and a Roth IRA. You max out your Roth IRA first, and then in your IRA, you continue to invest the rest of your money. And that money you can use however you want. So if you got paid dividends, say of $100 a month, you could pull those dividends out and use them to pay your cell phone bill or pay your internet bill or whatever you want. Or you could just reinvest the dividends back into the companies like the S&P 500, Realty Income, or what have you. That's all we're going to go over today on dividends. I know this was a lengthier video, but I wanted to give a really robust video for anyone that was new to dividends, so you could see the difference between investing in a company like Walmart or Home Depot versus a REIT stock like Realty Income, see some of the dangers of what would happen if you invested in like Disney or Boeing and the dividend gets cut. And then, of course, the safe track of putting money in something like the S&P 500, ETF SPY, or ETF VOO. Thanks for watching, everybody. Hit that subscribe button, and I'll catch you next time.